right, welcome back. Let's show you shares of Netflix today. Interesting note from Bernstein, which says hedge funds are poking around on the short side here, especially at $700. They do reiterate their market performance. 625 is their price target. Weiss, you're trimming it this morning.
Yeah.
What do you make of that note? Now, you're doing it because it's such a large position.
Yeah.
But what do you think in total here?
So if you call when the stock got hit, I really increased the position. So now it's still one of my largest positions, but it was 30% larger than any other position, which made it irresponsible to have that as continued risk standpoint, risk management standpoint. I make nothing of the hedge fund news shorting it. First of all, short position's only 2%, number one. Number two, I'd love to be in the opposite side of the trade of all the portfolio short positions of hedge funds over the last 5 years. They short because they have to. That's why they charge 2 and 20. So they look for liquid names or they do indexes. So, and having been a former hedge fund manager, that's the game. So I don't care about what their thought is. What they should watch out for is that Netflix, because if you saw the new Disney, Hulu, etc., Netflix could raise prices yet again. So,
well, that's what the Bernstein analyst says. He's bullish on that, by the way.
Yeah, I mean, look, do you want to try and trade it because it's had such big momentum? You can roll the dice and do that. I wouldn't. But, you know, the funny thing is I went to sell it this morning, and the stock was up like $5. And while I'm trying to put together where the shares are going to come from, it's up 5, it's up 6, it's up 7, it's up 8. So finally I just said, look, you know, this is looking a little dicey here. So I just sold it because I do think it's ahead of itself right now.
I own it personally. I agree with everything that Steve's saying. I mean, I think you've had these moments where it appears to be correcting. You've got these little palpitations in the market, and it comes back very quickly. Look, Scott, if you owned the JOTI ETF, which holds Netflix long, and you're sitting there long Netflix, and I come on air and I say, hey, I just sold Netflix, you would be bothered by that. So I'm kind of bound by the problem that I have where we're 30 days out from the rebalance. Would I be upset if someone rang the register on Netflix right here? No, I wouldn't. I really wouldn't, because I think it's run pretty strong. I know for me personally, I have a good gain in it, and I have no problem bringing the register because I think we're getting a lot of the good news that's built in.
Well, to be clear, it's still one of my largest positions. I only cut it back.
What do you do with Palantir, which is up 52%?
You stay with
since August 5th.
And it's higher today. So I know exactly. I'm sorry.
52% in 6 weeks?
I'll let you continue.
It's up 52% since August 5th.
Okay. And we had today the downgrade from outperform at Raymond James.
Raymond James. Time to move to the sidelines was the commentary.
On valuation. That's what we're citing. All right, look, if you want to move to the sidelines on this company, which is seeing significant growth in the commercial business, at least show me the evidence that the commercial business is reversing the growth and the market share gain that it's capturing. If you could see that, then yeah, you want to ring the register on Palantir. Otherwise, the stock is in the momentum sweet spot. And the momentum sweet spot is not just technical, it's fundamental. The business is pivoting from being focused on government relationships and government contracts to building out the commercial segment and utilizing AI. And they're showing you in their earnings that they're successful in that endeavor. So it's up 52%. You're correct. The S&P inclusion helped with that appreciation. But I think this stock goes back to the November of 2021 high, which is somewhere around $45. I could see the stock approaching $50 easily.
All right. I got Uber today, reiterated by at Jefferies. Price target's $100. Everybody owns it, but Jenny, you go first.
Thanks. So when we bought this a couple of years ago, the thesis was that it was going to generate $2 billion of free cash flow in 24 and $4 billion in 25. Meanwhile, they're generating $7.5 billion this year. They're expected to generate $9.5 billion of free cash flow next year. So it's the kind of thing where, like, even from a fundamental perspective, you keep holding it. Who cares about the momentum? Who cares about the technicals on this one? The fundamentals are amazing. The free cash flow generation wildly exceeds anything we could ever expect. The competition's gotten less for them, which drives the business. However you cut it, it's just a positive story here.
We're like Oscar and
Felix. But wait a minute. Hold on.
The only problem I have is I hate that 39 times multiple, but when the growth is so significant, you can continue to hold it. So
Hold on a second. Yeah. I'm sorry to interrupt you. Wasn't, like, I don't know, I'm trying to remember, handful of months ago?
Yeah.
You trimmed it, didn't you? Or at least you, and then you were somewhat skeptical of it when Brad Gerstner was on the day he was on.
Well, remember, okay, so we've trimmed it twice. It's still a huge position in the growth portfolio. And what Gerstner was saying then was he was basically, I can't remember the exact price target, but it was really high. And I was saying to him, how do you get there? And he said to me, you need to be a believer. You know, and we have been. And that's why we've continued to hold it, because I couldn't get there straight on the numbers. The numbers didn't make sense. But Brad was right.
Sounds like you were like
no, but
a doubting believer.
Okay, I'm a cynic. You've all figured that out by now. I'm always doubting. I'm always a little cautious. It's why I manage our dividend income strategy. My partner Greg manages the growth strategy. You know, it balances out. But I'm always cynical. I'm a cynical bull. And that's just how it is, which is why you trim a little, take a little off.
Okay.
But there's an important point here, too, which is it's a little different than Meta, where on this one, the original investment thesis, which is they are going to generate enormous free cash flow, is still intact. On Meta, it's a little different now. The valuation isn't that compelling. The growth rates aren't quite as strong. So I would say, and this is purely speculative, if we look back in a year from now and one of those two positions isn't in the portfolio, it's more likely to be Meta than Uber. Still holding Meta for now.
Joe, trade desk, neutral, Moffett-Nathanson today, $100 is a price target. That's down about 7% from where we are now.
Yeah, I want to give Jenny something she could appreciate other than momentum. Do you like free cash flow generation, 33% growth for the next 3 years?
Flow.
That's what this company is going to do. 33%.
Sounds like you should be talking to Greg, though.
Free cash flow generation over the next 3 years, $51 billion market cap. This company is in the sweet spot for ad tech, and they're perfecting on it.
Okay.
Oh, and by the way, the momentum's good.
All right.